Today, we're diving into a luxury asset class that's gaining attention in the investing world, luxury watches.
We're talking about collectible timepieces from brands like Rolex, Patek Philippe, and Audemars Piguet. Watches that aren't just accessories, but real investment assets.
These aren't just about telling time. They're about preserving and growing wealth through tangible, highly sought after collectibles.
Some models are considered blue chip assets in the watch world, with decades-long legacies in global demand. They're often compared to fine art or vintage cars for their rarity, craftsmanship, and performance as long-term stores of value.
Luxury watches, especially those from top-tier brands, have proven to be surprisingly resilient and profitable. Over the last decade, some watches have not only kept pace with inflation, but outperformed many traditional investments. Certain models hold or even appreciate in value, especially when production is limited, wait lists are long, or the brand intentionally restricts supply to maintain exclusivity. In some cases, owning a specific model can yield returns of 2 to 3 times over retail within just a few years.
Investors might buy watches and hold them long-term or flip them on the secondary market as values increase. Some even build diversified watch portfolios across brands and models, balancing liquidity and appreciation potential. Rarity, condition, and brand reputation are all factors that affect a watch's value. A watch with original papers, a rare dial variation, or a celebrity connection can command a substantial premium. It's a market that rewards knowledge, timing, and a bit of intuition.
The challenge? This market is driven heavily by brand culture and supply-demand dynamics. It's not always easy to know which models will go up or drop off. Now let's score luxury watches using our Fastfire Investability Score so you can see how they stack up to the stock market. Now if you're not familiar with our scoring system, watch this video here so you can see how we use the scoring system to break down alternative investments.
Starting with return potential, watches can definitely go up in value, especially during hot markets. But overall, most models don't outperform traditional assets unless you're picking from a short list of highly desirable models. That's why we give watches a C for return potential. There's upside, but you need serious expertise to consistently win.
Next up is risk profile. This is a niche and somewhat illiquid market if you're looking to get top dollar. Prices can fluctuate based on hype, fashion trends, or macroeconomic events. And unlike real estate or stock dividends, watches don't produce income. That adds to the risk, so we give them a C here too. Last is accessibility. While technically anyone can buy a luxury watch, the reality is to invest at a meaningful level, you need to be connected to a trusted dealer, understand the market, and have enough capital to buy quality pieces.
Accessing the most desirable models often isn't as simple as walking into a store. Many top-tier watches are not available at retail unless you have a strong relationship with an authorized dealer. And even then, you may need to wait months or years for a chance to buy certain watches. Without that connection, your only option is the secondary market, where premiums are steep. That's why we give luxury watches a D for accessibility. For example, a few months ago I stopped by a Rolex boutique in San Diego, where I have a personal relationship with the store manager. During my visit, he offered me a chance to purchase a Rolex GMT Master 2 with the iconic Pepsi bezel, a model that's incredibly hard to come by. This particular boutique only receives 4 of them each year, and many buyers wait years to even be considered. The watch retails for $11,300, but due to its rarity and high demand, it typically resells on the secondary market for $25,000 to $28,000.
Or a Patek Philippe Nautilus. If you'd gotten one at retail a few years ago, you could have seen 2 to 3 times appreciation. But not every model behaves like that, and during downturns or when demand cools, prices can drop fast. That's why education and timing matter. Luxury watches might be a fit if you love the culture and history of luxury watches, have the time and capital to research and buy them selectively, or want an alternative store of value that's portable and insurable.
But it's not ideal if you're looking for passive income or liquid assets.
So here's how luxury watches score. Return potential is a C, risk profile is a C, and accessibility is a D.
Okay, that covers our investability score for luxury watches. If you want to compare luxury watches to the stock market or other alternative asset classes, download our full investability scorecard by going to fastfirecapital.com/guide.
And remember to like this video, subscribe, and join us next time as we explore other alternative investments that the ultra wealthy use to build and protect their wealth. See you next time.